Welcome to this explainer. Today, we're totally shifting gears away from that whole get-rich-quick illusion. Instead, we're going to focus intensely on how real, lasting wealth is actually built. We'll be decoding the mechanics of stocks, the reality of Bitcoin, and, the true psychology behind financial growth. Let's just jump right in.
Most people actually ask the wrong question when it comes to money. They're always asking, how can I get rich fast? But the people who actually build wealth, they ask this entirely different question. How can I make my money work for me while I sleep? It's a massive shift in perspective, really. It moves you from thinking about money as just something you earn and spend to treating it like a tool that can literally grow on its own.
Okay, let's dive into this because today is strictly about knowledge, discipline, and time. It is absolutely not about overnight luck. Seriously, the absolute fastest way to lose your hard-earned cash is to believe someone who promises you fast money. The real secret to wealth? It isn't luck at all. It's built on a solid foundation of smart, consistent decisions that you repeat over years and years. So, here's our roadmap for today. We're going to cover 1. The big wealth truth, 2. Stocks and Bitcoin explained, 3. The biggest beginner mistake, 4. Building strong money habits, and finally, 5. Assets versus liabilities. All right, let's kick things off with Section 1, the big wealth truth, shifting your mindset. Now, the traditional trap basically looks like this. You wake up, go to work, pay your bills, and then just wait for that next salary. And the catch is, if your income relies entirely on your time, well, the money stops the exact second you stop working. But the wealthy, they operate completely differently. They focus on owning assets. They're constantly asking themselves how they can invest instead of spending, and how to make decisions today that are going to compound for their future selves. Moving right along to Section 2, Stocks and Bitcoin Explained, going beyond the buzzwords. Let's get one thing straight right off the bat. Stocks are not magic lottery tickets. Buying a stock means buying a small piece of a real company, giving you actual ownership in a functioning business. When you invest, you're essentially betting on that company's ability to innovate, scale globally, and drive profits. And as their value grows, so does your piece of the pie. But we have to remember, real businesses can also fail. Things like a weak economy, changing interest rates, fear in the market, or just sudden bad news can absolutely crush valuations overnight. If you're ignoring these macroeconomic risks, well, you aren't really investing, you're just gambling. Now, let's look at Bitcoin, which offers a fundamentally different financial mechanic. It's a limited, global, digital asset. People often view it as digital money or a borderless store of value. The big appeal here is its decentralized nature. It's not controlled by a single company or government, acting, for many, kind of like digital gold. But here's the thing. Bitcoin can be incredibly powerful, but it is not safe just because it's popular. Because it's a highly volatile asset, the price swings wildly up and down. Sure, some people have made money, but a lot of people have lost their capital because they bought out of pure emotion, panic, or greed. Just because an asset is the talk of the town doesn't automatically make it a safe harbor for your cash. And that brings us to Section 3, the biggest beginner mistake, the danger zone. This step-by-step cycle is what truly causes people to lose their money, not necessarily the investments themselves. Step 1, a beginner sees the hype and feels that intense fear of missing out. Step 2, driven by all that excitement, they buy in at a really high price. Step 3, naturally, the market drops. And finally, Step 4, they panic, sell everything at a massive loss, and swear off investing forever. The market ruthlessly punishes people who invest based on fear and hype rather than a solid plan. So how do we fix that? That's Section 4, building strong money habits, rebuilding your mindset. Instead of asking what's going to make them rich this week, people who build real wealth ask themselves these highly disciplined questions. They want to know, what can I understand deeply? What can I hold patiently through market storms? What risk can I actually handle? How can I invest regularly without wrecking my day-to-day life? And, importantly, how can I protect myself if things go south? The contrast between poor and strong money habits is pretty stark. Poor habits mean chasing quick profit. Strong habits are about building slowly and consistently. Novices try to guess the perfect day to buy, while experienced investors know they can't time the market, so they just invest regularly over time. And while amateurs tend to put everything in one place on a single bet, the pros obsessively manage risk and diversify. Now, this next point is a completely non-negotiable rule. Never invest money you need for rent,
food, debt, or your family's safety. Especially with volatile assets, you literally have to ask yourself, what happens if the market drops 30% tomorrow? The only way you survive those drops without panicking is by only investing what you can actually afford to lose.
All right, moving to our final segment, Section 5, Assets versus Liabilities, Structuring Your Wealth. It really all comes down to understanding this one simple comparison. Assets bring you income or grow in value. We're talking stocks, businesses, education, skills, and strong brands. Liabilities, on the other hand, are things that take money straight out of your pocket. Buying the most expensive phones, luxury cars, designer clothes. Look, those do not grow your wealth. They just drain it. And this brings us to a really profound truth. Many people want to look rich before they actually become rich. They buy all those expensive liabilities we just talked about just to show off, but they own zero actual assets. In reality, a vast majority of self-made millionaires, they drive used cars. Real wealth is often very quiet. It isn't about showing off. It's about having freedom, having security, and having choices. Think of it this way. A hammer can build a house, but it can also break your hand if you swing it blindly without any skill. Money and markets work the exact same way. Stocks and Bitcoin, they're just raw tools. So before you start chasing profits, you absolutely have to build your baseline knowledge and your emotional discipline. As we wrap up this explainer, I want you to take a hard look at your own habits and ask yourself this final, crucial question. Are you building your financial knowledge, or are you just chasing the hype? Remember, the real path to wealth isn't a lucky guess. It's learning, patience, and smart decisions repeated over years. Take the time to master your tools and make your money work for you. Keep learning, stay disciplined, and thank you so much for joining me today.